I think that central bankers just don't have history of being able to orchestrate a soft landing in an environment like this, where inflation is running very, very hot. Monetary policy, for the most part, is a very, very blunt tool. So you're looking at just raising rates, and the sources of inflation we're seeing right now, supply chain disruptions, labor market shortages, and higher gas prices. I mean, these are not things that the Fed really controls. So it's the only thing that they can do is tighten monetary policy quite aggressively, and what that will eventually lead to is a meaningful slowdown in growth and potentially even a recession down the line.
How far down the line? There are a lot of people who think we're already in a recession.
Yeah, I think it's really hard to fully pinpoint. I'm just not seeing anything in the data right now that points towards a recession in the next 12 months. But, if we do keep up the pace of rate hikes that markets priced in, which is for the terminal Fed funds rate to get to 4% in short order, I think you're going to see a recession, perhaps, sometime in late 2023 or 2024, if financial conditions also continue to tighten as much as they are right now.
Lindsay, Subhadra laid it out very well. I mean, this is a situation that the Fed's in a box. They don't really have the tools to fix this. So what do you anticipate hearing from them? What's the right solution? What's the best that they can do with the tools they do have? What will we hear today?
Well, the Fed's going to need to walk back market expectations, which have increased markedly, to suggest a 75 basis point hike is coming. The Fed has been very clear that that is not something they're actively considering. And so they will have to reaffirm that rhetoric and convince the market that we are seeing improvements in inflation, and the Fed does expect inflation to continue to retreat going forward. Yes, the headline number surprised to the upside, but when we exclude food and energy, which of course consumers pay for, but from a monetary policy standpoint, this was reassuring as we continued to see that second derivative decline or improvement, a slower pace of still positive price appreciation. So the Fed is going to have to remind the market that we are taking steps in the right direction, that 75 basis points is not something that they're looking for, and they will continue on this more controlled pathway. Also, we have to remember that aside from raising rates, the Fed is also beginning to draw down the balance sheet, which will essentially act as a de facto rate increase. So even if we do see 50 basis points as we expect, with that additional policy action, it will feel more to the market like 75 basis points, essentially. And so the Fed is going to have to be very clear in their policy pathway, pointing to the improvements and also reminding market participants that growth is slowing, the consumer is slowing, and the risk of recession is rapidly rising as we look out. I think it's much earlier, to the end of this year or early 2023.
When will we know? I mean, I guess the official decision has to be named by the Council of Economic, the economic team, the NABE or whoever it is who actually decides on a recession. But when will we know and be able to say pretty certainly, Lindsay, that it's here already?
Well, it's the NBER that will officially call the recession. And you're right, it will be certainly in the rearview mirror. I think we'll feel it very early on as we start to see consumers pull back more dramatically than they already have. When we start to see investment tip onto the into the red, when we start to feel growth slow markedly. And so I think it's going to be very clear that we're in a period of negative activity or moving into recession well before the officials declare it so.
Subhadra, what do you think about that? Is the idea that we could be in a recession sooner? What would change your mind about that? And as a result, how would you change your outlook?
So fundamentally speaking, I think that the economy is in a very good spot right now. Unemployment is at 3.5%. Manufacturing is still pretty strong, but you are starting to see some nascent signs of concerns in the market. The one metric that I track that's tried and true is the yield curve. The 2-cents part of the yield curve is flattening quite dramatically. 5/30 part of the curve actually even inverted recently. So that to me is an important indicator that the market's starting to get very concerned about a meaningful slowdown in growth. Broadly speaking, I think corporate profit margins are still pretty healthy, so you're not going to see that in the data now. It's really a question of all the forward-looking indicators. What happens to the consumer in the next 6 to 8 months? How much of a top line and bottom line impact it's going to have on corporations and corporate profit margins down the line? So it's really hard to get accurate visibility on those metrics right now. As far as the Fed, I think is concerned, they really want to clamp down inflation. And what they're really concerned about is, the inflation expectations getting unanchored. I mean, the Michigan consumer survey, the 5 to 10-year survey, inched up, and that is a big concern for them. And they're going to need to do everything they can to try to clamp down inflation expectations so that expectations don't get entrenched in the system.